I think Netflix has some serious challenges ahead, and I want to dive into those with you in this video. So welcome to my laptop world. Today we're looking at the shareholder letter for Netflix released on January 21st, 2020. They put these out every quarter, super detailed. Netflix does an awesome job with their investor relations. Just take a look at the results here. We're looking at revenue of about $5.5 billion, up about 31% for the year. Positive operating income of $459 million, but that is very misleading because they do lose a lot of money on other parts of the financial statements because they're investing so much on content, despite the fact their income statement shows a profit. So we're gonna get to more of that in a second. The company did show earnings per share of $1.30. The biggest number to watch that I like to look at for Netflix is how many streaming memberships did they have? How many customers are paying them for their service? The most important core metric for health of their business. Like I said, first quarter since Disney Plus launched here in the US. So interesting to see how this unfolded. They still were able to grow that number 20%, although they do have that slowing to about 16.9% for their Q1 2020 forecast, which I think is interesting. Pretty dramatic slowdown in the past year from 25% growth of that subscriber base down to the mid-teen percentage. And if we see on a net ads basis how many net users they're expecting to add in Q1, about 7 million, which is less than the almost 9 million in Q4 and significantly less than that 9.6 million in Q1 2019. Now, this is the very interesting part of the business. Net cash used in operating activities, as you can see, significantly negative, basically how much money the core business is spending. The way this works, it's a little bit of a tricky accounting game here, is they're spending all this money up front to produce all this content and shows, but then they amortize the expenses of that content over time as sort of the useful life of that content plays out. Let's say you produce a big show like Friends, for example, or Seinfeld. I mean, these shows, they cost a ton of money up front to produce, but then you get years and years worth of revenue and value from those contents, and so they amortize those expenses over time. So Netflix has to spend billions of dollars up front on its content library. That's why their cash flow is so weak, yet their earnings on their income statement appear so positive. So Netflix, this is a huge quarter. They lost $1.46 billion in operating activities, $1.7 billion in overall negative free cash flow. So the business is burning tremendous amounts of capital. If we go into the Q4 results and forecast, in Q4, paid memberships grew 21%. Average revenue per user, ARPU, increased 9% year over year. That's mostly due to them raising prices. Would have risen about 12% if you excluded that impact of foreign currency. So I think that's pretty interesting. Solid trend there. But then you get to the point of how long is Netflix going to be able to raise prices? I mean, Disney Plus is coming in, undercutting them on price. We have Hulu that also undercuts them on price. Additionally, we have this new streaming service from Comcast, NBC Universal, called Peacock, which is going to be launching in mid-2020, which is going to have a free tier. They're going to have a $4.99 tier with some ads, and they're going to have a $9.99 tier with no ads. So a ton of streaming services are coming online, not only coming online, but with a lower price point than Netflix. And so up until this point, Netflix really hasn't had much competition for the streaming service. So I think their ability to raise prices is very much in question here going forward. And that has been a key driver of their revenue growth. So I think that's really interesting. But then on the flip side, I always think back of how much were people paying on their cable bill? Probably 60 to 70 bucks a month for cable. So you could still pay 20, Netflix, what is it, 14, 15 bucks for a premium HD service now. They could raise that to 20. You could still spend 10 bucks on Disney Plus, 10 bucks on ESPN, 10 bucks on Hulu. We're still looking at 50 bucks a month, which is less than you would have paid for cable for probably a much better offering with no ads content when you want it. So I think overall, what's fascinating about the streaming wars, getting a little bit sidetracked here, is the value, what we're getting, what you and me are getting for our money is amazing. There's like a massive deflationary pressure on the pricing for these content companies. I mean, we're paying less money to get better content with no ads. I mean, if linear TV in a 30-minute TV show has like 5 minutes of ads, which is absurd because you're also paying for the cable package, which is 60 to 70 bucks a month. Imagine, it's just it's night and day difference in terms of the quality for consumers. So in many ways, we are the winners of the streaming wars, which I think is awesome.